Let's look at a case study in which we are looking at three different cases, case A, B, and C, in order to determine which of these investment cases would be the most profitable for the equity investor. So imagine you are a film and television executive who works for a film finance company, and a producer comes to you with a project that is budgeted at $10 million. So you now have to run three scenarios and determine what would be the best scenario for the equity investor. What is the best way to finance this film under the following terms and conditions? We have three cases here. In the case A, you would simply assume that the equity investor would cover the entire budget, meaning their investment would be 100% equity. In the scenario B, you would have pre-sales done for 35% of your budget and would have those pre-sales cash flowed by a lender, assuming that the lender would cash flow 80% of those pre-sale agreements, applying an interest rate of 7% for the 2-year term. And you would also consider that the distributors who bought the pre-sale deals make a down payment of 20%. You are shooting in a production incentive region that offers a 25% of the budget incentive, and you're going to get a loan where a lender charges you 5% of the loan amount. The equity would then finance the balance due to cover the budget. And in scenario C, all of the same applies as you have in the case B, but in this case now, you are also including a gap loan from a senior lender, which is provided to you against unsold rights, but also assuming industry standard terms applicable with most senior lenders that are providing gap loans, which are capping the gap loan at 20% of the budget. The valuation that you would have for this project would show that 75% of the budget can be covered from international rights distribution revenues, international distribution rights revenues, and 35% would be assumed to be covered from US distribution rights revenues. Your sales agent charges you 16% of all the worldwide sales they establish. The collection agent charges you 1% of all the revenues that hit the collection account. And the equity investor charges you a premium of 20% of the principal investment amount. Plus, they will apply the industry standard profit participation, which is 50% of the percentage of the investment in relation to the budget. The question now is, how much is the net revenue or loss in each of the cases, A, B, and C, and how much is the payments we're making to the equity investor in each scenario? So in case A, the funding schedule is pretty simple and straightforward. It assumes that 100% of the $10 million budget is covered by the equity investor. And as mentioned before, our project valuation would take under consideration that 35% of the budget of $10 million is being covered through US distribution rights revenues, and 75% of the budget is covered through international distribution rights revenues, which gives us a worldwide gross revenue from distribution of $11 million at the worst case scenario, the take scenario for this $10 million picture. And now we're taking a look at the recoupment schedule for our case A, where we have financed the entire film with equity. Again, we have distribution revenues gross at $11 million. Now, the applicable deductions are applied here. First, the collection agent fee of 1% is deducted with $110,000, which is 1% of 11 million. The sales agent charges us 16% of 11 million, which is 1,760,000. We have no bank loan. The principal equity investment would be $10 million. And if that's the case, our total expenses would be 11,870,000, but we're only making $11 million in revenues, which leads us to a net loss of $870,000. The equity would only be paid in this scenario $9,130,000. They would not make their $10 million investment back. In comparison now, we're running the case B scenario where we still have the movie at $10 million. We are still assuming the valuation to be $11 million with worldwide gross revenues. But we're also structuring our finance plan now applying international pre-sales of 35%, which is $3.5 million. And we are receiving 20% of that from our distributors in connection with those pre-sales that we have established. So that is $700,000, and that's the first amount we have raised and would be raising in this case. So then we are looking at our senior loan option. We are assuming that our bank is giving us 80% of the pre-sales that we have accomplished of $3.5 million, which would be $2.8 million. We're deducting the down payment because we already received this and will be using it to cover a portion of the budget. The bank will not give us a loan for that. So the net loan for these pre-sales is therefore $2.1 million. We are applying our interest charge of 7% and are left with a net pre-sale loan of $1,953,000. We're not looking at the unsold rights in this scenario because we're not assuming to be taking a gap loan. Instead, we will be increasing the equity. So we are looking at a net loan of $1,953,000. Additionally, we're adding our down payment of $700,000. And we are also assuming that we have a production incentive of 25% of the budget for $2.5 million. We have a lender fee applicable here of 5% because we're getting a loan against this estimated production incentive. And the lender fee is 5% of $125,000. The net incentive loan we would be receiving is $2,375,000. Together with the bank loan and the down payment we received from the distributors, we have secured $5,028,000, which would leave $4,972,000 to be covered through equity in order to cover the $10 million budget. And here's what the recoupment schedule would look like for this film. Again, we have our gross distribution revenues at $11 million. We are deducting the down payment that we already have received and used from the distributors, which is $700,000. So the collection account will register $10,300,000 in distribution revenues gross. The collection agent will then charge their fee of 1% on this amount, which is $103,000. The sales agent will charge their distribution and sales fees of $1,760,000 again. The bank loan gross, which includes the interest charges here now, is $2.1 million. The equity principal investment amount was $4,972,000. We're paying this back together with a 20% premium of $994,400. So our total expenses would now be $9,929,400. We are then achieving a net revenue of $370,600. So that is the distribution revenues of $10,300,000, deducted expenses of $9,924,400, gets us a net revenue of $370,600. The equity investor gets 50% of the equity they have given us, which, as you remember, was in total, I believe, if I'm looking at this case study here, 49.27%. So half of that is 24.9%. And the equity investor therefore gets a profit share participation payment of $92,131. And the producer would be left with $278,469. Now the equity investor is looking at $1,086,531 as a payment that is made to them, which is comprised of the premium of $994,400 plus the profit participation of $92,131. And the net revenues, as I mentioned earlier, were $370,600 in this case B. So in case C, we have the same assumptions as we just did in case B. Our worldwide gross revenues are still estimated to be $11 million. The pre-sales are still $3.5 million, and the down payment you're receiving in the first installment from the distributors is still $700,000. So those are sitting for us, waiting to be used to cover the budget. The pre-sale loan net is still $1,953,000. Now the bank will actually give us a gap loan, and we have to figure out how much that is by first establishing our unsold rights value. That we do by taking our international distribution revenues of $7.5 million and deducting the pre-sales that we have secured, which were $3.5 million. So we're left with $4 million worth of rights that we can still sell. The bank will take this under consideration and give us a $2 million gap loan. 20% of the budget is also $2 million, so the budget cap that the bank will likely require is therefore the same amount. The gross gap loan is $2 million. We're deducting 7% of interest fees of $140,000. So we're left with a net gap loan of $1,860,000. So that changes our senior loan to $3,813,000. Now the incentive is still the same, 25% of the budget, netting out to $2,375,000. So altogether, when we look at the finance portions we have collected here, we have $2.375 million for incentives, we have $3,813,000 for our gap loan, and we have $700,000 for the down payments. Altogether, we have secured $688,000. We're needing $3,112,000 in order to reach the production budget of $10 million. So the equity now is $3,112,000. So looking at the recoupment plan, here we are seeing that the equity looks a little different now that we have structured this finance plan a little different. So we're still making our $11 million in worldwide distribution revenues. We're deducting the $700,000 that we already received from the distributors as the first installment payment, and we have used to cover a portion of our production budget. So we're at $10,300,000 as revenues right now. The collection agent will then again charge their 1% fee of $103,000. The sales agent again will charge their 16% fee of $1,760,000. The bank loan is no higher, it's $4,100,000 because we added a gap loan to the equation, but the equity is lower at $3,112,000, plus we're paying a premium of 20% of that, which is $622,400. So all in all, our expenses are now $9,697,400. So if we take these expenses and we're deducting it from the revenues, we are left with net revenues of $602,600. And when we're looking at the equity investor, they're receiving now a 15.6% profit participation payment, which is $93,765. That, in addition to the premium that they received of $622,400, gets them a payment of altogether of $716,165. So the answer here is our net revenues are $602,600, and the equity payment due to the equity investor is $716,165. So this is your example for the step-by-step guide to answer the quiz question. And looking at your quiz, you would run the same scenarios, case A, B, and C, but you are changing the costs for the film. While the assumptions are the same, the costs for your film have now increased to $15 million. So how much net revenue or losses will you have and achieve in each of the cases A, B, and C, assuming the same assumptions apply for a film with the budget of $15 million?